Hey everyone, it's Daniel here from InfoVest. Hope you're all doing well. So we finally got the CPI report came out. It came in basically in line, the month over month number in line for both the headline and the core number. Now, however, the year over year number, especially the headline number, did come in a little bit higher than expected, about 6.4% versus the expected of 6.2%. And another important part of the data is the real earnings came in way higher than last month's, which is 0.7% versus the last month's of 0.1%. So the data, basically, if you were to summarize it, was relatively in line or as expected. The stock market initially sold off and right away picked back up in terms of short-term moves. And then later around before 9:30 a.m. we had selling again in the stock market, followed by a massive rally, sell off again, and then later a rally later in the day again. And it's just been nothing but choppiness. And quite expected, because when you get an inline number and you've got a number that, 50% of the traders looking at the markets as if, this could be a good thing, or the other 50% looking at it saying that, hey, it's still relatively high. When you look at the year over year numbers, 6.4%, we're still not coming down. It's still elevated, so Fed needs to do more. And we did hear some Fed members come out and repeat the same things. And actually, some of them were slightly more on the hawkish side of things, saying that we need to do more, that the services component, especially when you look in the CPI report, the shelter and the food and part of energy as well has increased for this month's data, and we still have a long way to go in terms of bringing inflation down to the 2% level. Now, when you look at the goods component is relatively low, but the services component is a big problem. So the services component is what the Fed has told us and mentioned to us before and talked about, especially housing. And when you look at shelter and housing, on the other hand, yes, it has picked up. And yes, it is a number that the Fed and a lot of the FOMC members are looking at. And it basically gives, when you look at the data, and for me, when I look at the data from more of a long-term point of view, not short-term, not medium-term, but long-term down the road, in order to get this inflation down lower, and in order to also get real earnings to not spike up like it showed today, and in order to get shelter and food prices to come down, hopefully, right? You still got to continue with the rate hikes, continue with the narrative of hiking rates, still bringing tightening. And the whole idea of this pivot that the market is basically assigning a lot of weight to, especially the equity market, saying that we're going to see rate cuts soon, has basically started to somewhat diminish, right? So we moved from seeing two rate cuts by the end of this year to now one rate cut, and slowly that is diminishing, especially when you look at the bond market on this data. And still throughout the day, the bond market, especially the short end, continued just a very simple fashion, sell off, because, hey, an inline number and a year over year, when you got a year over year number showing 6.4%, that's going to show up on the news, on the articles, on the newspapers out there. And headline numbers, what retail, what individuals, consumers look at. They don't really know much about core, but that's what they hear about. And if they hear that, then guess what? It trickles into inflation expectations. So if that's seeped into the heads of the consumers, expecting that, hey, inflation is still high and inflation is a problem, then they will go back to their employers and say, hey, we need a higher salary, higher wages. That's why, you might see the wage component still continue to be higher than expected, continue to be sticky. That's why when you saw, I think it was a month or two back, when Walmart came out saying that they're increasing their minimum wage it's still having an effect today, creating that sticky inflation today, which is creating elevated inflation, having higher inflation, as there's a problem with two things. One is the labor market, as a lot of businesses out there are still looking for people to work, and they're having a tough time, yet incentivizing more people to work by increasing the wages. Although we have, yes, heard some layoffs, but this is still the beginning. Like I've said many times, that these layoffs that you saw in the tech industry is just the beginning, just the start. We haven't really seen the true effects of all the tightening and more tightening to come, and how that will affect the economy, and how we could see more of a hard landing than a soft landing. But when you look at the equity markets, it's still pricing in a soft landing. When you look at the stock market, they're not selling off the way the bond market is, which is very telling, because it's telling you that the equity market is completely brushing off the year-over-year number, completely brushing off the real earnings number, completely brushing off the signal from the bond market, because you've got the bond market and the short end selling off, and the yield curve basically made a new low, inverted even a little bit deeper. So it went down a little bit and picked back up, and the equity markets are completely ignoring it, and we're still seeing resilience and strength in the equity markets, even though on CPI day it was very, very choppy. So what does this all mean? What does this all mean for the markets? Could we see the equity markets continue moving higher? Sure, right? We could see short-term, medium-term equity markets move up higher until they realize that, hey, this might be worse than expected, until the soft landing narrative is completely out of question and we start talking about hard landing. Now, when will that come? Hard to say, hard to time out. Sometimes it takes 2 years for a recession to really show its signs. And especially with all the QE and money printing that we did, more than in history, it could take longer, maybe not. Or maybe I could just be simply wrong about a hard landing. But I'm still on the side that a possible hard landing is coming. Maybe we see it in September. Maybe the trader that made that big bet in the video that I did yesterday, who made a big bet on rates hitting to 6%, may be right that, hey, September we're going to see that hard landing, or maybe end of the year or 2024. But either way, definitely the lag effect is there. Definitely it's going to take its time. Definitely you are seeing inflation still elevated and sticky. And are we in a disinflationary period? For sure, we are seeing certain areas, certain sections, especially the goods area, come down, but it's not enough, because we gotta get to that 2% target like the Fed has been telling us over and over again, and they're not changing their mind about that. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, and the bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.